So let's review chapters 1 through 9. So our first question here tells us that Emily Valley is a licensed dentist, and during the first month of operation of her business, the following events and transactions occurred. So we're going to be given a list of transactions, and we will need to journalize these transactions, post them into T accounts, and then prepare a trial balance. So our first transaction here, we are investing $20,000 in the business. So we need to think about what kind of accounts are being affected by this transaction. So when we look at this, we can see that the owner's putting money into the business, right? So that's going to increase the amount of cash that the business has. So cash is an asset account, and to increase an asset, we debit our cash account. So we'll make sure that we debit cash in this entry. And then we need to think about, okay, what kind of account would be credited? Well, so cash is going into the business. What is the owner getting? The owner's getting more of a stake in the business, right? So we call that owner's capital. So we credit our owner's capital. And now owner's capital goes up with this credit. And then the amount, we just toss in the $20,000 that we were told in the transaction. Our next piece of information here. April 1st, hired a secretary receptionist at a salary of $700 per week, payable monthly. Now here, we need to be careful, because this employee of ours has only just gotten hired. There hasn't been any work that they've done. They haven't earned any money. All that's happened is that you've called them up and said, congratulations, you're hired. So that's not a transaction. And if something is not a transaction, there's no journal entry that we would need to record. So we're not going to have any entry required whenever you're told that you just hired an employee. Later on in this problem, we'll see when we finally have to pay this employee, and that is when we will start recording the expense surrounding their salaries. Now on April 2nd, you paid office rent for the month of $1,100. So here, we can think about what kind of accounts are affected, because this is a transaction. If we were paying for the office rent for more than just 1 month, like if we were paying in advance, let's say for a full year, that's when we would use our prepaid rent account. But here we're just paying for 1 single month. So when you're just paying for 1 single month, we debit rent expense. We just count the expense for April here. So that's going to be our debit. Then we think about our credit. How did we pay for this rent? Well, it doesn't tell us that we paid for it on account. And so that means that we used cash, right? Whenever you just see the word paid, we can think that cash is involved. So we credit our cash here to show that our cash is decreasing by this $1,100 amount. Then on April 3rd, purchase dental supplies on account from Dazzle Company for $4,000. So once again, we need to think about what sort of accounts are affected here based off of some keywords that we see in the transaction. So we're buying dental supplies, right? So we see the word supplies there, and we know that we need to debit our supplies account to show that our supplies are increasing, because supplies is an asset and assets go up with debits. And then how did we pay for these supplies? Well, it tells us that it's on account. So that on account is telling us that we're going to pay for it later. So we will credit our accounts payable. And we'll just toss in the 4,000 there as our amounts. All right, so let's move on to April 10th. We performed dental services and billed insurance companies for $5,100. So once again, we think about what kind of accounts are being affected. There's a few key words here. When we see performed services, that's telling us that we need to start thinking about service revenue. So we know that service revenue is going to be one of our accounts. And then we see the word billed, that we billed insurance companies. So that means that we're going to be getting paid in the future, right? People owe us money. And whenever people owe us money, we can think accounts receivable. So our two accounts here are service revenue and accounts receivable. And we know that they both have to increase. And so service revenue is a revenue account, and revenue accounts increase with a credit. So that will be our credited account. Accounts receivable is an asset, and assets go up with debits. So we'll debit our accounts receivable and credit our service revenue for this $5,100. Now on April 11th, received $1,000 cash advance from Leah Smith for an implant. So Leah Smith is paying us before we do any of this dental work. So we haven't truly earned this $1,000 yet, but we're getting this cash right now. So we need to show that our cash is going up. We need to show that we're getting this money in. But then our credited account here is going to be unearned service revenue. So whenever you get payment before you've earned that money, we need to count this unearned service revenue. And unearned service revenue is a liability, and liabilities go up with this credit. So we're increasing our cash and we're increasing our unearned service revenue in this entry by that $1,000. Now on April 20th, we received $2,100 cash for services performed from Michael Santos. So once again, we received cash. So anytime that we receive cash, we can debit that account. Now, why did we receive this cash? Well, we received this cash because we performed services, right? So just like I said back on April 10th, whenever we see the words performed services, that's telling us that we need to count our service revenue. So we'll debit our cash and credit our service revenue for this $2,100. Now on April 30th, we're finally paying this employee of ours that we hired back at the start of the month. So this is when we start to count the expense, right? Because now they've done the work for an entire month. So there's something for us to actually record now. So we debit our salaries expense because expenses go up with debits. And then we'll credit our cash because we are giving money to this secretary receptionist. And so that means that our company's cash is decreasing. And we'll just toss in the $2,800 that we were given. Another one here on April 30th, we paid $2,400 to Dazzle for accounts payable due. So if we think back to earlier in this problem, when we purchased supplies on account, we increased our accounts payable on that day. On this day, we are paying back some money. We are paying Dazzle $2,400. So that way we don't owe them as much anymore. So we're going to want to show that our cash is decreasing, and we're going to want to show that our accounts payable is decreasing. Because if we are paying them back, we need to show that we don't owe them as much money as we did previously. So accounts payable decreases with a debit because it's a liability account. So we debit our accounts payable and we credit our cash for $2,400. Okay, again, if there's any questions at any point, feel free just to interrupt me. Otherwise, I'm just gonna keep on talking, right? So just let me know if you have any questions at all. So now that we have all of these journal entries over on the left side of our screen right now, we can now post these into T accounts. So we could post them into a ledger or we could post them into T accounts. Either way, what we're trying to do is we're trying to keep track of these account balances, right? Because if I asked you right now, how much cash do you have after these 8 to 10 journal entries that we just recorded? You're not going to know that answer right off the bat, right? So we use these T accounts to figure out these balances. So if we just look at our T account here, and let's just take a look at this cash one first. So at the top of our T account, we have the account name, right? The left side of the T account will be the debit side. So anytime that you debit cash, we put that amount over on the left side of our T account. Anytime that we credit cash, we toss that amount over on the right side. So the left side is the debit side, the right side is the credit side. So we'll go through entry by entry and post them into the T accounts. And then at the end, we can go through and figure out what the ending balance is in each of these accounts. So our first journal entry that we had, we debited cash for $20,000 and we credited owner's capital for $20,000. So we can toss that $20,000 on the debit side for cash and the $20,000 over on the credit side for owner's capital. Our next journal entry, we debited rent expense and credited cash for $1,100. So we toss those in to the T accounts. And notice how cash, the debit of $20,000 is over on that left side, the credit of $1,100 is over on the right side. Now, our third entry, we debited supplies and credited accounts payable for $4,000. So we throw those into our T accounts. Then we debited accounts receivable and credited service revenue for $5,100. Those go into their T accounts. Next, we debited cash for $1,000 and credited unearned service revenue for $1,000. So we post those. Then debited cash $2,100 and credited service revenue $2,100. We can put those into their T accounts. Then we debited salaries expense and credited cash $2,800. And then our last entry, we debited accounts payable and credited cash for $2,400. So now we've posted all of our entries into these T accounts. Now that we do that, we can find the balances in each of these accounts. Now, you'll notice a lot of them, right? The accounts receivable, supplies, owner's capital, all those have just one single entry in them. So finding their balances will be really simple because we just take the one entry that we had. But something like cash is going to be a little bit trickier. So we have 6 different entries that affected cash. So there's a few different ways that we can attack this here. We could add up each side, so add up the debit side, add up the credit side, subtract those two amounts, and put that balance on whichever side had more. Or we could also look at it from an account per account basis. Cash is an asset. So those 3 debits to cash make your cash account go up. Your 3 credits to cash makes your cash account go down. So if we take the 20,000 plus the 1,000 plus the 2,100 and then subtract out our 3 credits, so minus 1,100, minus 2,800, and minus 2,400, we're left with a debit balance of 16,800. So that's how much cash you have after the month of April and all of these transactions that happened. Now, like I said, accounts receivable, that's going to be much easier. That's just going to be our 5,100 because we didn't have any other entries that affected it. Supplies, just the 4,000. Then we come to accounts payable. Accounts payable, once again, we have multiple entries affecting that account. Now, we could just take the difference and put the balance on the side that had more. Or we can look at it from the accounts payable point of view, right? Accounts payable is a liability. Liabilities go up with credits and go down with debits. So that 4,000 is a positive amount. We subtract out the 2,400 and we are left with 1,600 as a balance over on the credit side. Unearned service revenue, just that 1,000 as a credit. Owner's capitals, just 20,000 as a credit. Then we get to service revenue. Service revenue, we have 2 credits, right? If you just have 2 credits or just 2 debits, what you'll do is just add those up. So we could just take 5,100 plus 2,100 and we'll take the 7,200. Now, if we look at this from the revenue perspective, revenues go up with credits, right? So that was a positive 5,100 plus another 2,100. And that's how we end up with this balance of 7,200. Now, rent expense and salaries expense, those just had single entries affecting those. So we just bring those balances down. So now that we have all of our account balances in these T accounts, we can then create a trial balance. So a trial balance is going to look like this. You have the company name, you have trial balance, and you have the date that you prepare it. And then we see a column for our accounts, and then we see a debit column and a credit column. What we're going to do is we're going to list out those 9 accounts that we had in our T accounts that we just solved for. We're going to list those out and their balances here on this trial balance. And now there's a specific way that we want to list out these accounts. We list out our accounts based on the expanded accounting equation. So that's your assets, then your liabilities, owner's capital, owner's drawings, revenues, and then expenses. Right? We list them out in that order. And then our assets. Our assets have to be listed out in a specific order themselves. And we call that the order of liquidity. The order of liquidity is how quickly we can turn that asset into cash or how quickly we're going to use up that asset. So the first asset that you'll always list is cash itself, because cash is the most liquid because it's already cash. And you'll notice we take that 16,800 amount that we found in the T accounts and we put that balance under the debit side because it's a debit balance in cash. After cash, we list out our accounts receivable. That had a debit balance of 5,100. Then we have our supplies. That had a debit balance of 4,000. That was the end of our assets in this example. So then we would move on to our liabilities. We had two different liabilities. We had our accounts payable, which had a credit balance of 1,600, and we had unearned service revenue, which had a credit balance of 1,000. So then we're done with our liabilities. After your liabilities, you list out your owner's capital. So we had owner's capital with a credit balance of 20,000. After your owner's capital, you would list out your owner's drawings. Now, we didn't have any owner's drawings in this example problem, but if we did, we would list our owner's drawings, and owner's drawings has a normal debit balance, so that balance would go under the debit column. Then after your owner's drawings, you list out your revenues. We had one revenue account here, just our service revenue. So we put our service revenue and the credit balance of 7,200. After your revenues, we list out our expenses. We had two different expense accounts. We had our salaries expense with a debit balance of 2,800, and we had our rent expense with a debit balance of 1,100. Then, now that we have all of our accounts and their balances listed out, the next step in a trial balance is to add up your debit column and add up your credit column, because we want to make sure that our debits and credits equal, right? So when we add up our debits and add up all of our credits, we will see that we get total amounts here of 29,800 for both the debit column and the credit column. Now, I want to go over a few things just in case your debits and credits don't equal, right? The first step is I would want you just to re-add up your debits and credits. The vast majority of the time, you just probably plugged in a number wrong into a calculator. Maybe instead of 1,100 for your rent expense, you accidentally just put in 1,000. And that messes up your total amounts there, right? So just make sure that you didn't make just a math error while calculating your totals. Now, if you go through and you realize, nope, I didn't make a math error, there's a few things that you can do. Let's say that our debits and credit total amounts are off by 1,000. If there's a $1,000 difference between your total debits and your total credits, we would take that 1,000 and we would divide it by 2. So we would have 500 then, right? And we would take a look in our trial balance itself for an account that has a balance of 500. And if we can find an account that has a $500 balance in that trial balance, we might have just put it on the wrong side. We might have put it on the credit side when it's supposed to be on the debit side. We might have put it on the debit side when it's supposed to be on the credit side. Right? So that's step number one. If that doesn't work, we can see if the difference between your total debits and your total credits is divisible by 9, right? So let's say total debits and total credits have a difference of 900, right? 900 is divisible by 9. So then we're looking for a transposition error. So we would have to reference all of these balances back to our T accounts or back to our ledger and see if we just flipped around some numbers. So maybe for salaries expense, it wasn't supposed to be 2,800. Maybe it was supposed to be 8,200. Right? So that's a way to pick up on any sort of transposition errors. Now, if it's not a simple math error, if you don't have a balance in the wrong column, if it's not a transposition error, and your debits and credits still don't equal, then you have to go back to your ledger or to your T accounts and see maybe you miscalculated something there. If not, then you go back to your journal entries. Make sure that there's no errors there, right? So we would just go back one step at a time throughout this entire process. But as long as our debits and credits equal, we're good to go and we can move along in our accounting cycle. Now, question 2 here says that Okabe Company ended its fiscal year on July 31st, 2017. Using information from the company's trial balance, we need to calculate net income or net loss, total assets, total liabilities, and ending owner's capital. Right, so we're given our adjusted trial balance here. And we know that our net income or loss is our revenues minus expenses. So let's first figure out our revenues. So our revenues are the service revenue that we were given of $64,000 and our rent revenue that we were given of $6,500. Have a bit of a typo here. So our total revenues should be $70,500, right? We just add up our two revenues. So you add up your two revenues and you find your total revenue amount. Then we have expenses. We have 3 different expense accounts here. We have our depreciation expense, salaries expense, and utilities expense. We would find our total expenses then. And once we have our total revenues and we have our total expenses, we can then take those amounts and subtract them to find that we have a net loss, right? So if your expenses are greater than your revenues, you're going to have a net loss. If your revenues are greater than your expenses, you have a net income. So remember that we would find this amount on an income statement, right? The first of the 4 financial statements that you prepare. Then we can go through and find our total assets. So our total assets, the best way to do this is to take a look at your adjusted trial balance and just figure out which of these accounts are assets. So we just talked about, while preparing a trial balance, your assets are listed first, right? So we go to the top of our adjusted trial balance here and we see that we have cash. Well, cash is an asset. Accounts receivable, that's another asset. Equipment, that's another asset. And then we get to accumulated depreciation equipment. That's going to be a contra asset. So you guys also probably just learned about another contra asset called allowance for doubtful accounts, right? So these are still going to be included while calculating your total assets. But instead of adding them, we're going to subtract a contra asset because it takes away from our asset accounts. And then on our adjusted trial balance, the next account is accounts payable. We know accounts payable is a liability. So we've accounted for all of our assets here. We just have these four. And we can add the first three and subtract out our accumulated depreciation to find a total asset amount of $27,120. Then we need to find our total liabilities. So we take a look back at our adjusted trial balance. And we already said that accounts payable was a liability, so we can toss that in. And then we have unearned rent revenue. And this is one where students get tripped up a lot. Unearned revenue is not a revenue account. If it's unearned revenue, it will be a liability. So we take our accounts payable, we take our unearned rent revenue. We see that the next account listed on our adjusted trial balance is owner's capital, right? So we are now done with our liabilities. It's just payable and unearned revenue. We add those up and we get a total liability amount of $6,020. Now, ending owner's capital. We're going to go about this one by creating a owner's equity statement, right? So if we think about preparing owner's equity statements, an owner's equity statement is going to begin with your beginning owner's capital, or your owner's capital at the start of the month, at the start of the year, whatever the time period is that you're preparing this statement for. And that's that $45,200 that we're given on this adjusted trial balance. Then there's a few different things that would be added to your owner's capital on an owner's equity statement, right? There would be investments and there would be net income. Well, we weren't told anything about investments here for Okabe Company. And when we calculated our net income or net loss before, we saw that we had a net loss instead of a net income. So in this example, we don't have anything that's going to be added to our owner's capital. We do have some things that are going to be subtracted. So we're going to first subtract our net loss. That was the amount that we found when we took our revenues minus expenses. That's not the only thing that will be subtracted, though. The other piece that's subtracted on an owner's equity statement are your owner's drawings. And we see our owner's drawings there on the adjusted trial balance, and they're $16,000. So we want to combine those two pieces that we're subtracting out. So we add up our net loss in our drawings to see that we need to subtract a total of $25,100. And that will give us an ending owner's capital then of $20,100. We take our beginning owner's capital minus that $25,100 to give us this ending owner's capital amount of $20,100. So now let's think about some of the other chapters, right? We really just focused there on a lot of chapter 1 and 2 stuff. So if we move on to chapter 5, you started learning about merchandising companies. So companies that would sell inventory, sell goods rather than services, like we dealt with in the first 4 chapters. So in merchandising companies, whenever they make a sale, they're going to have 2 different entries. So the first entry, whenever a merchandising company makes a sale, is to record the credit sale or the cash sale itself. So this entry is dealing with the amount that you charged your customer. So here, Summer Company sold $1,000 of merchandise to Wilkes Company. So we need to say that we made sales of $1,000. So that's why we're crediting our sales revenue for this 1,000. And then we're also saying that Wilkes Company owes us this 1,000. Now, how do we know that it's accounts receivable and not cash? Because we take a look at those terms. We're given terms here which replace the words on account that we were used to previously. Right? So whenever we see terms like that, we know that this was a sale that was made on account. So Wilkes owes us this $1,000. Now there's another entry that's required from the point of view of Summer Company here. And that's recording what these goods cost the seller. So they have to record their cost of goods sold and their inventory amounts here. Cost of goods sold is an expense account. So we're increasing our cost of goods sold with this debit of $650. And then we credit inventory $650 because we need to show that we don't have as much inventory anymore. Right? Because our inventory is going down because we just sold some to Wilkes Company. So we don't have as much inventory, so we decrease our inventory account. So those will be the entries whenever a merchandising company makes a credit sale. Remember that we have those two entries that are required. Now there's a few other points in this transaction information here that I wanted to go over. First, FOB shipping point. We're either going to see FOB shipping point or FOB destination. What that's telling us is who has to pay for shipping, who has to pay for the freight costs, right? So FOB shipping point is saying that the transfer of ownership happens at the point of shipping. So then it's the buyer's responsibility. So the buyer has to pay for shipping when it's FOB shipping point. So in this case, Wilkes Company would be the one responsible for paying for all of the freight costs. The other option is FOB destination, meaning the transfer of ownership doesn't happen until the goods reach their destination. In that case, the seller is responsible for all of the freight costs. Now we have these terms, right? Terms 210 net 30. What that's telling us is that there's going to be a 2% discount if Wilkes Company pays back within 10 days. Or Wilkes Company has to pay the net, they have to pay everything that they owe within 30 days. So what Summer Company is trying to do here is they're trying to give Wilkes Company a little extra incentive to pay early. Because Summer Company wants to have that shorter operating cycle. They want to get their cash as quickly as possible. Because then they can use that cash to buy more inventory, or they can use that cash to invest it somewhere else. So they're willing to give Wilkes Company that little 2% discount if it means that they get their cash earlier. Right? So sometimes these terms will change. It could be 410 net 30. It could be 110 net 30. They could completely change up these numbers, right? So just remember that the way that this is written is the percent discount if they pay it in a certain amount of days. So 2% if they pay it within 10 days, or they have to pay the net within a certain amount of days. So here the net amount is due within 30 days. Chapter 6 brought on perpetual inventory. Now, we don't have enough time to go through FIFO, LIFO, and average cost problems. But we do have time to talk about what all of these methods and cost flow assumptions mean, right? So FIFO, it's first in, first out, meaning the first inventory that you bring into the warehouse, those are the ones that you're pushing out first. LIFO, last in, first out. So the most recent inventory that you just purchased, those are the ones that you're pushing out first. And then average cost is when we combine all of our inventories together, find this weighted average unit cost, and we don't really keep them separate like we do for FIFO and LIFO. Now there's going to be some pros and cons for these different cost flow assumptions, right? So FIFO is going to give you a lower cost of goods sold. So that sounds good, right? Because we just talked about how cost of goods sold is an expense. So we're going to have a lower cost of goods sold, which means we have a higher net income. So things are sounding real great for FIFO, right? We want to be able to say that we have a higher net income. So FIFO sounds pretty good right now. LIFO gives you a higher cost of goods sold and a lower net income. On the surface, doesn't look real great, right? Saying that you made less money over the year, that's not going to make your stockholders real happy, right? But what this does is it lowers the tax burden, right? So if you have a lower taxable income, you have to pay less in taxes. If you have a higher taxable income, like in FIFO, you're going to be paying more in taxes. Now, average cost is going to be just somewhere in between. The cost of goods sold won't be as low as FIFO and won't be as high as LIFO. The net income won't be as high as FIFO's or as low as LIFO's. And then the tax amount will be somewhere between FIFO and LIFO's as well. Now, a company cannot just switch up all the time, right? There's a lot of work that goes into making these changes. They have to go back multiple years and re-prepare all of their financial statements if they want to switch from one cost flow assumption to another. So they're not going to just be constantly making these changes. So a company is going to pick one and stick with it. Now, one other piece to remember here is that these assumptions that we just made, right, that your net income's higher under FIFO and your net income's lower under LIFO, that is only true if prices are increasing, right? Now, typically, prices of goods increase over time, right? The amount of money that it costs to buy a gallon of milk back in the 1940s is a lot less than what it is today. So the price of goods tend to increase over time. And we have to use that assumption in order for this information to be true. Because if prices were to be decreasing over time, then everything would be flipped. Let's talk about special journals now. So in chapter 7, you learned about these special journals. So we had our sales journal, we had our purchases journal, we had cash receipts and cash payments. And then if if a transaction didn't fit in any of those 4 special journals, we toss them into the general journal. So we're going to go through a few transactions here and figure out which special journal they should go into. But the way that I want you to be thinking about this is the first question you should ask yourself is cash involved? Because if cash is any way involved in a transaction, you know it's either going to be the cash receipts or the cash payments journal. If cash is not involved, then we know that we can think about the sales journal, purchases journal, or the general journal. So our first transaction here, cash sales. So we see that word sales there, and the first thought might be the sales journal, right? That would make the most sense. However, the sales journal is only for sales of merchandise on account. So this is where asking ourselves that initial question of, is cash involved, is really going to come into play here. So is cash involved in cash sales? Yes. So then we can think about, are we getting cash or are we paying cash? So if we make cash sales, that means that we are the one receiving this cash. So if we're the one receiving this cash, we would record that in the cash receipts journal. Now our next one here, credit sale of merchandise. So we can ask ourselves, is cash involved? The answer is going to be no, right? Because it's not a cash sale of merchandise. It's a credit sale, so it's a sale on account. So if you made a sale of merchandise on account, that's the definition of what goes into the sales journal. Now make sure that for something to go into the sales journal, it fits all of that criteria. It has to be a sale, it has to be of merchandise, and it has to be on account. All 3 of those must be true. Now our next one, owner withdraws cash. So once again, we can ask ourselves, is cash involved? Yes. Right? So once again, we narrow it down into either the cash receipts journal or the cash payments journal. Here, we're looking at this from the perspective of the company. The company is losing cash in this transaction. So if the company is losing cash in this transaction, it's going to go into the cash payments journal. Our next one, purchase of merchandise on account. So we ask ourselves, is cash involved? Well, we don't see cash anywhere in that transaction. Right? So we know that cash is not involved here. So we've eliminated the cash receipts and the cash payments journal. Instead, we can think it's either the sales journal, the purchases journal, or the general journal. Well, your purchases journal is to record a purchase of merchandise on account. So it's kind of the other side of the sales journal, right? The sales journal was to record a sale of merchandise on account. Well, your purchases journal is for purchases of merchandise on account. And again, it has to fit all 3 of that criteria. If it does, we can toss it into our purchases journal. Now, cash purchase of land. So we might get a little a little sloppy here and see the word purchase and think purchases journal, right? But again, it's not of merchandise and it's not on account. So we ask ourselves that first question: is cash involved? The answer is yes, right? So we know it's either the cash receipts journal or the cash payments journal. And if we are purchasing land with this cash, that means that we are paying for that land, so it's going into our cash payments journal. Our last one here, equipment depreciates. So if your equipment is depreciating, we can ask ourselves, is cash involved? No, right? If we think back to our adjusting entries back in chapter 3, to record depreciation, we would debit depreciation expense and credit our accumulated depreciation, right? So there's no cash involved in that entry, in that transaction. So we know it's not cash receipts or cash payments. And then we can ask ourselves, is it a sale of merchandise on account? No. Is it a purchase of merchandise on account? No. So it's not the sales journal. It's not the purchases journal. Since it doesn't fit into any of those, this is one that goes just into your general journal, right? It doesn't fit into a special journal. It just falls into your general journal. Now, your general journal is going to be used for things like your adjusting entries, like this one. Your closing entries, like when we close revenue to income summary and close owner's drawings to owner's capital, right? Those closing entries that we learned about in chapter 4. And then it would also be used for your correcting entries. So your adjusting, closing, and correcting entries. So we can think of that as ACC, just like accounting, right? Those are what would fall into your general journal. Then chapter 8 rolled around, and we learned about bank reconciliation. So bank reconciliation is done so in that way the amount on your bank statement matches your amount in your ledger. Right? What we're doing is we're adjusting our cash balances to make up for either some errors or some time lags, right? So we take a look at this example that we're given, and it says that Terry Davidson was unable to reconcile the bank balance because Terry made some mistakes, right? So we need to correct the errors that Terry made in this bank reconciliation that we're given. So what Terry did was he put numbers into the wrong, or put the adjustments into the wrong sections, right? So that NSF check, it's not supposed to be added on the cash balance per bank. Deposits in transit are not supposed to be subtracted from the per book side, right? So we need to move those around to fix this bank reconciliation. So we're going to set up our framework like this. So we start off with our cash balance per bank. That's the amount that's on our bank statement itself. This $35.60 and 20 cents. And now we need to think about what would be added to the cash balance per bank. So this is something that will increase the amount in your bank account, but the bank doesn't currently know about it. So we take a look at our options over there. And our option that we're going to choose is our deposits in transit. So a deposit in transit, you can think of it this way. You own a company and you've recorded in your books that you've deposited $530. And then you tell one of your employees, hey, here's $530, drive this down to the bank for me and deposit it in our account. in the company's mind, they already have that money. So the books side already knows about it. The bank, on the other hand, has no idea that someone is on their way to the bank to make this deposit. It's currently a deposit in transit, right? So that's going to be maybe the easiest way to just imagine what a deposit in transit is. Now, what's going to be subtracted on the per bank side? Well, we have three options left, right? We have the NSF check, the bank service charge, and outstanding checks. So let's go piece by piece. An NSF check. An NSF check is a not sufficient funds check, right? It's a check that bounced. So this is a check that a customer wrote you and you thought it was a good check, right? You're going to trust your customer that they have the money. But once you gave it to the bank realized that customer doesn't have the money, right? They tried to get that money and the check bounced. So the bank already knows about that. They were the one that discovered that there weren't enough funds in your customer's account, right? So the bank already knows, so we don't need to make this adjustment to the per bank side. Then we look at the bank service charge. Well, the bank is definitely going to know that they're charging you a service charge, right? They're the ones that decided to charge you a $25 service charge. So they already know about that. Then we're left with outstanding checks, right? Process of elimination, we know that outstanding checks is going to be the piece that falls in here under the less section on the per bank side. But why? Well, an outstanding check is when you as a company write a check, but the person that you wrote it to has not taken it to their bank yet, right? So if you wrote me a check because you love this review so much and you wanted to pay me $730, let's say, I'm busy for a little bit still, so I might not be able to take it to the bank immediately. So on your books, you would say, well, yeah, I definitely paid Steven $730. But your bank has no idea that you wrote me a check for $730 until I take it to my bank, right? Until I put that into the bank account. So while it's still out there in the world, it's considered an outstanding check. That would take away from your balance in your bank account. So we have to subtract it from our cash balance per bank. So if we take our cash balance per bank that we have, add in our deposits in transit, subtract out our outstanding checks, we can see that our adjusted cash balance per bank equals $3,360.20. Now we can take a look on the per books side. So we know that there's two pieces left, right? We have the NSF check and we have the bank service charge. Those are both going to go on the per books side of a bank reconciliation. We need to think about, okay, is it going to increase or decrease our cash balance? So let's start with an NSF check. An NSF check, like we said, was a not sufficient funds check. It's a check that you thought that you had. You thought you had already received the payment. But then the bank comes along and tells you, nope, that person didn't have the money. So you are then going to have to subtract that out from your cash balance per books. Because you had already recorded that you received payment of $490. But reality is you never got that money because your customer didn't have that money to give you. So we're subtracting out this NSF check here. Then we come to the bank service charge. Well, if the bank charges you a service charge, that's going to mean that you have to pay them money, right? So that's also getting subtracted out here. So you'll notice we don't have anything under the add section on the cash balance per books. One common piece that could be added would be the collection of a note. So the bank sometimes acts as like a middleman for you, and they'll collect a note receivable on your behalf. If that happens, that would be added on the per book side of a bank reconciliation. We just don't have that here. So we have the two pieces that we need to subtract to find our adjusted cash balance per books. So to find that, we take our cash balance per books, that $38.75. That was the amount that was in our ledger before we did any of this. We subtract out our NSF check. We subtract out our bank service charge. And we see that our adjusted cash balance per books is $3,360.20. So where do we see that? We see that our two adjusted cash balances, the per bank and the per books, equal. It's not a coincidence. It's the reason that we do this. We're doing a bank reconciliation, so then that way our adjusted cash balance per bank equals our adjusted cash balance per books. Because you have a definitive amount of cash in your possession. There can't be two separate amounts, right? You either have the money or you don't. So in this case, you have $3,360.20. And now that's what your bank will know, and that's what your company's books will know. So now the last piece that we're going to go over here tonight, the allowance method. So we use the allowance method to help estimate an uncollectible amount. So in a perfect world, we would be able to collect all of the money that our customers owe us. In reality, that doesn't always happen, right? Sometimes people don't pay back the money that they owe us. So a company will use the allowance method to help them estimate some uncollectible amounts. So we're told here that the ledger of Preston Company at the end of the year shows balances in accounts receivable of $175,000, a balance in sales revenue of $550,000, and a balance in sales returns and allowances of $35,000. Then, if your allowance for doubtful accounts has a credit balance of $2,100 in the trial balance, journalize the adjusting entries at December 31st, assuming bad debts are expected to be first 1% of net sales, and then we'll do this whole problem assuming that bad debts are expected to be 10% of accounts receivable. So under the allowance method, we have these two different ways that we can go. We can go under the percentage of sales basis. That's what we're going to do first. Or the percentage of receivables basis. There's going to be some steps and some pieces that will look similar. But the way that we figure out our numbers, that changes between the two different bases. Right? So let's start here with this 1% of our net credit or our net sales. We don't know our net sales, right? So we're given some information where we can find our net sales, and then we can talk about what 1% of that is. So your net sales, in this case, will be your sales revenue minus your sales returns and allowances, right? Sales returns and allowances is a contra revenue account, so it gets taken out from your revenue. So we take our $550,000 minus our $35,000 of our returns and allowances, and we see that our net sales is $515,000. So that's step one, right? Because if we need to take 1% of our net sales, we need to know first what our net sales even are. Now we can find what 1% of it is. So 1% of our net sales, we take the 515 that we just calculated, and we multiply that by 1%, or in decimal form, that's 0.01. And we get 5,150. So now that we have 1% of net sales, that's the amount that we are assuming or estimating will be the uncollectible amount. Right? We're sitting here saying we think that we won't be able to get $5,150. That's just going to be an amount that we'll never collect. So we need to journalize that. The way that we journalize that under the allowance method is we debit our bad debt expense. And then we're going to credit our allowance for doubtful accounts. So the good news in the allowance method is that whether you're working in the percentage of sales, like we are in this part, or the percentage of receivables, like we'll do next, the framework of this journal entry is going to be the same. You'll debit your bad debt expense and you'll credit your allowance for doubtful accounts whenever you are estimating uncollectible amounts. Now, our number. We found our 1% of net sales to be 5,150. We're also told that our allowance for doubtful accounts has a credit balance of 2,100. That credit balance only comes into play when we're doing the percentage of receivables basis. So we'll talk about in part 2 of this problem how we bring in that $2,100 credit balance. But here, when we're doing the percentage of net sales, we found that 1% to be 5,150. So that's the amount that we're going to toss into our journal entry. So we debit our bad debt expense for 5,150, and we credit allowance for doubtful accounts for 5,150. Now, let's work on the percentage of receivables. Right? So what this is saying is that 10% of our accounts receivable will be uncollectible. Right? So once again, we're going to need to figure out what 10% of our accounts receivable are. So we take our accounts receivable balance that we were given up above of $175,000. We multiply that by our 10%, or our 0.10. So we see that 10% of our accounts receivable is $17,500. Now, unfortunately, we can't just throw that number into our journal entry. There's going to be another step here. And that's when we want to create a T account for our allowance for doubtful accounts. If we do that, it's going to be the easiest way to visualize what's happening. So we see that we have an initial credit balance of 2,100. So we put that credit balance there in our T account. And we just found that we want the ending balance to be 17,500. This entry that we're preparing here on December 31st is going to be for the amount that would fall in that red circle. How do we get from a credit balance of 2,100 to an ending credit balance of 17,500? Well, to find that amount, we're going to subtract our two numbers that were given. So 17,500 minus 2,100. And we see that we need to credit an additional 15,400 to our allowance for doubtful accounts. So we debit our bad debt expense and credit our allowance for doubtful accounts, just like last time. But this time, it's for that 15,400. So we are increasing our allowance for doubtful accounts by this 15,400. Because remember, allowance for doubtful accounts is a contra asset. And contra assets are going to increase with a credit.